morning, Eagles. Who's ready to soar above the crowd? We have a great guest today. Professor Steve Keen is going to be with us at the top of the next hour. I'm not going to take up a lot of time. Nicola Duke's going to be with us today. So the whole team is going to be covering the board for us. So let's start off with Euro Pound. On Monday, I talked about buys in here. 88.10. I think it was Tuesday is the day. Tuesday in here. Yesterday talked about taking partial profits up here, buying a pullback towards 40 to add that half back, and here we are at 89. So this isn't quite the target that I talked about at the beginning of the trade. We're almost there. So you may want to take another piece off. I think there's a chance for us to see a 90 handle. But this was a wedge I was using for a target. And that comes in right around 89.04. So, yeah, 89. $89.05 or so. So we're close. Here's the wedge line. I was looking for 100% retrace. We're on our way. So this was an excellent buy. I think most people were pretty negative this pair. The reason I was positive this pair was my bearish bias in the dollar, which the whole ForexAnalytix team has been negative dollar for quite some time now. So on Tuesday, I also said fade dollar strength. My preferred trade on it was the long euro pound. Another negative day in the dollar. Nice update that we're at here. This was Tuesday, so you had a couple trades here. I do believe we're heading down, and we're going to head down to take out below the move, something that I've been talking about for a while. So here's your daily. So I'm actually looking for new lows here. This is starting to look like a bear flag right here off this straight line move. It could take it to 90. So dollar still looks very negative to me. The team really took advantage of a weak dollar by being short yen crosses, in particular euro yen. There were some pattern in place that took advantage of it. We're getting a rebound here basically because of the euro, but there were some big trades here. This is your daily. You look at the hourly. In fact, our CEO Blake was negative up here at 6.5 and put out a pattern in play here. This most likely is setting up some type of rally to get short again. There could be lower objectives, but big trades on the short side of yen crosses over the last week or so. Some people were calling for a high in gold. We got a nice scalp on that third drive in gold, but with dollar weakness, I think there's still a chance. And I teach the 3 drive, and sometimes in a third drive you could have 3 on the final third. It will be a fractal. So gold really not participating much with the weak dollar, but if there's more left in the euro and we're headed above the 120 handle, I have a hard time wanting to get short right here in the gold. But this was 1, 2, 3, and in here early in the week I said expect one more high. That's what we've got. I didn't like the RSI reading up here. It was pretty stiff above 70. So if we get another rally here and we set up a 3 within this third drive, gold could be a good short as well. I really don't like to fade precious metal strength when the dollar is weak. It's kind of out of sync, but I would say on a relative strength basis that the gold is not acting great today considering how strong the euro is. Everyone with me on the analysis? Good morning, Elena, Tom. Steve is in here with us. Looking forward to interviewing you, Steve. Patrick, how are you? Everyone doing okay? So I also just want to make an announcement here. Since you're running out of time to invest in your trading future, the promo is going to end on Monday. So we have a link right here in the room. But excellent deal. It's almost like half off, buy one, get one free. Good discounts on the semi-annual and on the annual plans. And as you know, we do have a private chat room where there are a lot of professional traders, not people that do it for a hobby, but they take care of their families and with money that they pull out of the market. So although we're here for an hour of analysis and a half an hour for an interview, the private chat room is here all day long and evenings. There are people here for Asia, people here for Europe. So it's another advantage besides all the great research that you're going to get on the traffic light page and all the analysis that we get here. So I think it's a good time to consider becoming a member. Remember that when you're a member at ForexAnalytix, you're not just getting Elliott Wave, you're not just getting harmonics, you're not just getting conventional technical, you're not just getting candlestick analysis, you're not just getting macro, you're getting all of it. So you have, plus you have Amanda doing a great job in the private chat. She's a professional trader, keeping that room really orderly and also having fun in there. So, you know, we like to have fun. Sometimes we take our trading a little bit too seriously. You know, it's really something we do. It's not who we are. So you can form relationships in there. I've seen it happen. And with all that being said, hope you're able to catch a piece of Euro Pound. And no one that's been listening to our voices over the past few weeks has turned bullish a dollar. And we've been looking for shorting opportunities in the dollar for quite some time. I don't expect to be looking for long positions in the dollar until at least the 90 level, maybe 88.5, and that could be a few weeks down the road. Then I think we could start looking for the dollar to recover. Until that time, don't fight the trend. The trend is your friend, and use, just like last Friday, we talked about using dollar strength to fade after the NFP. It continues to work. So I'm not sure what the order of the team is going to be today. Steve, are you taking over from here, or is Blake?
It's actually Blake, yeah. Hey, okay. Good morning, Dale.
Hey, Blake, how are you, buddy?
Good. I had a special request today, and I know we have a really esteemed guest, and I don't want to mess around too long. I'm going to talk about a couple of things, and I know we have, like I said, we have a guest. We have a lot of stuff we want to cover. I think Nicola Duke's going to be here too. Grega might be here, so I'm going to make things kind of quick. First of all, the ECB minutes came out from just about 38 minutes ago. Really more hawkish than the market expected. So the euro got a nice little boost. Now we're back at the notice we're at the 618 retracement. We just pushed some stops above those highs around the 120.15, 120.18 level. Yeah. Almost enough, and it could have been enough just to stop out some people, because you have to keep in mind that the market was pretty aggressively selling euros this whole week. So when you get a more hawkish ECB commentary, you got a lot of people that had to take back those trades. One of the big trades of the week has been the euro yen. And before I talk about this trade, and by the way, I did really well with it. Yes, I did. I did get stopped out of some trades too. I was short the Kiwi dollar right through here, and it spiked up, and as I was short through around the 71.80 level, got stopped as it went through 72.10 over here. So I've had good trades and bad trades, but the euro yen was an exceptionally good trade because I was shorting it around 135.50, and closed it at 133.40 yesterday, somewhere around there. So that real close to those levels. But I want to talk a little bit about positioning, because the JT, I was in the chat room, as you were mentioning, our private chat room earlier. I was in the chat room last night. I'm always in the chat room. Whether I'm chatting or not is depending on what I'm doing trading wise, or if I'm on the phone or whatnot. I'm usually kind of half in, half out of the chat room all throughout the course of the day. I'm always commenting, except when I'm not sleeping or at some kids sporting event, it seems. But last night in Asia, I was talking to one of our traders, GT, and he's like, you know, Blake, I remember your webinar from a few years ago, back when I was with the Wise Trade Group, and you talked about, you drew a picture of a boat and positioning, and it really sank in, and it made me realize that when you talk about, you know, when you talk about a theme or a subject matter, I like to take several different approaches because you never know what's going to stick. So in other words, I like to explain things in several different manners because it's going to make sense to some people and it's not going to make sense to other people, but it will, you know, if I teach it a few different ways, it'll eventually resonate. And ironically, he was telling me that I was joking around about a time when I drew a boat, and I actually drew it just like, oh crap, let me move this Bloomberg chart. Give me 1 second. I hate it when it does that. So I need that chart out of the way. Okay, so I was talking about a boat, and I know this is going to be kind of funny, and I drew it, you know, just kind of like you see here. But actually, I'm going to get a different color. Let me grab a different color just to make it a little bit more visible. I'll use purple. Okay, so I had, you know, he goes, it's funny because you drew this and it made sense to me, and I'm like, okay, well, let's say you got a boat, right? This is a boat, and our chat room captain in our chat room, he's laughing at me. He goes, great, a guy in the desert that's drawing a boat. That's exactly what we need. So here's our boat, right? But what I was talking about is I was talking about positioning, and this isn't exactly how I drew it the last time, but this might give you an illustration. So the market is extremely bullish the euro, okay? You know, and speculative interest is at extremes. And so with the euro at the 120 level or near 120, 121, that means to me that there's a lot of people that are basically standing on this boat, okay? But they're all standing on one side, right? Then you have, in the yen, you have a lot of people, and that means because they're expecting price to go higher in the euro, and this is the euro yen. Then you have, on the flip side, you have the market that is extremely short yen. What does that mean? Well, they're expecting prices to go higher as well because they're short yen. So now you have more people standing on this boat, and you got everybody kind of standing on this boat, but they're all standing on this side of the boat. They're expecting prices to go higher. So Dale, when you have everybody on one side of a boat, what tends to happen?
It could capsize.
It could capsize. So you've got instead of this happening, you've got the opposite happening because you have the entire market on one side of the trade, and that has been, and that earlier this week or this weekend when I was explaining it in the explaining it in the, you know, the week ahead video, is I was explaining that positioning is extremely lopsided in the euro yen. You've got the market extremely aggressively long the euro, and you've got the market short yen, and so that record positioning is creating a situation where the boat could capsize a little bit, and that's what we're seeing in the euro yen. And now, granted, the euro yen bounced, and why did the euro yen bounce? Well, it was a couple technical factors that really played into it, in my opinion. We have a multi-month trend line that came into play. You see the 618 come into play here, or that's the 786. Actually, I should go from right here. It's a 618, but it was also, as you saw, the 78% retracement. A lot of technical factors, divergent relative strength, blah 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 blah. You can name a whole multitude of things why it bounced there. Then on top of it, you throw in fundamental factors like bounce and yields yesterday, which bonds had been selling off and yields have been rallying, so you would expect that the euro yen would eventually find some footing, and it did. So now that the euro yen's bounced, I'm back to looking on the short side again. Why? Because positioning doesn't change overnight. Positioning is not something that's going to really change in a quick manner. So at this point, we're seeing a bounce, yes, a recovery in the euro yen, but as I tweeted out yesterday, I am looking for, I'm already starting to sell some, but I'm looking for a turn up here, 134, 134.50, maybe even as high as 134.80. I wouldn't mind selling euro yen all the way up because positioning is still very skewed. Anyway, that was just a little example of me explaining why I'm still bearish the euro yen despite the rally. And yes, I did cover the euro yen yesterday when we were down at 133.30, 133.40. I thought I was a little early. I ended up being just a wee bit early, but we're seeing a bounce. And also keep in mind, and I see that Nicola Duke is here, so I'm not going to take up too much time, but also keep in mind that the euro dollar, even though we see these rallies, whoops, shoot, I didn't want to do that. Put that
Next
back.
time you draw a bolt, warn me so I could take a Dramamine.
So keep in mind that the euro may see some intraday rallies like we saw yesterday. An intraday rally, we sold off immediately. Now, we are rallying today because of the ECB commentary, which, when you have central banks moving the market, their commentary moving the market, it tends to stick a little bit better than just, normal order flow. So the euro yen may not have as aggressive sell-off, but positioning is still pretty skewed. So be careful being too aggressively long the euro at this stage in the game, especially that we're up here at the golden fib level. Now, with that being said, I'm going to turn your attention to Bitcoin, and I see Nicola Duke is here. Nick, are you here?
Hey Blake, yeah, I'm here. Hi.
What's happening? I saw you popped your head in, so I wanted to. I'm sitting here looking at Bitcoin, and we are speaking of multi-month trend lines. We have this nice little trend line that's really come into play. And we're at
a big deal, long-term trend line, and also a third touches of trend lines. So like I don't have the one tag on the left, but if you start with a sharp drop, third touches of trend lines very often are false breaks, followed by a sharp bounce. So that's exactly what we've seen. So that's even more bullish, I think, in this Bitcoin chart.
So real quick, now I want you to continue on here, but I want to say we got a little false break here. We're starting to get a bounce, but there was some very negative news out of South Korea. Now it's only South Korea. South Korea is not the world. So
it's huge. 70% of the volume is in Asia and China. Sorry, and a lot of people move from China to the Korean exchanges and Japanese exchanges. So no, Korea and Japan are huge, but that was fake news. Reuters have got it wrong. Even the BBC are reporting this wrong. The Koreans don't want to shut down Bitcoin exchanges at all. They want the taxes from them. And so they're going to make the Korean exchanges know their customers. And you can't trade, or you can't go from cryptocurrency to regular money unless they know who their customers are, so that they can collect the taxes. So that's all it is. Now, yeah, I think a lot of people from China are trading on Korean exchanges using VPNs, but the Koreans want their business. They want them to on their exchange, not in China. So they're not going to kick them off, and they're not going to shut them down. And there was a correction, and since then, in fact, in the last half hour, the Korean government have confirmed that they're not going to shut the exchanges down. So we're seeing a bit of a bounce.
Well, that makes a lot of sense. I mean, they basically want their money. They want their piece of the pie.
Yeah, they don't want people. They want to cut the loophole so that people can't make a load of money and avoid tax.
Nick, Blake, Dale, good morning.
Morning,
Nick,
hello.
I have a question for you.
Yes.
Supposedly the initial appeal of Bitcoin and all the cryptocurrencies, the fact that you could trade them, you could mine them, and keep your anonymity, etc., etc. I mean, my point here is the following: the more cryptocurrencies are being pushed towards getting regulated, which they should, because people will end up losing fortunes and definitely taxes are being lost, etc. isn't that counterintuitive with, I mean, doesn't it work against what was theoretically the value that people were looking for in cryptocurrencies? So in essence, isn't their own success going to push them?
I think you're right that on anonymity is certainly for some people a factor, and you can see that, you know, there are some new coins that are based on privacy. So Monero is one, XMR, and Verge. They're based on privacy. So, and that's why I think that they're quite popular. But no, I think the biggest appeal about Bitcoin was that people could send money to each other. So it's like peer-to-peer. So somebody in Africa can send money to somebody else in Africa, and they don't need a bank or anybody else who can get in the middle and say, oh no, or I would like a fee. You still have to pay fees to the miners, but it's nobody who's going to regulate it and stop you sending money. So I don't think that taxes, you know, that's what Bitcoin originally was. It wasn't supposed to be a store of value that we were going to buy like an asset to get rich off. If it's, you know, it's really a method of payment.
It's a money laundering.
Peer-to-peer, yeah.
I'm just kidding. I know.
You know, I think really that it can't be both. It can't be a store of value and an effective transmitter of money. So, well, I think it will go up. That doesn't mean it won't go up in value, but people who are buying it just because the price is going up, like that's not the thing. So, yeah, no, originally it was like, you know, because people like PayPal are turning people's accounts off, all sorts. You have to go through such drama with PayPal, but with Bitcoin, it's what PayPal I think originally was supposed to be. So yeah, for me that's more the appeal. So I don't think it's so much about avoiding taxes. It's just, you know, an easy, simple method that avoids the banks and got huge. Look at when it got hugely popular, right after the credit crunch when the banks were completely disgraced.
Right.
So,
that's true. That's true. So what now? We were having a discussion yesterday with our team meeting, and I don't want you to go into too much detail because I know you want to be a little bit more elaborate with perhaps a blog and a written type of format.
I'm writing a blog post, yeah.
Yeah, but talk to us a little bit about you know, the just some of the relationships that you've noticed between Bitcoin and some of the other you know, altcoins, if you will, whether it's Litecoin or Ripple or whatever.
Yeah, so there's a few things to note. You know, there are some big, you know, for me, there are some big altcoins. So your Ripple has become one of the big ones from out of nowhere. But like Ethereum, right. Litecoin, Ripple, Dash, they're the kind of bigger alternative coins. And what tends to happen when Bitcoin slows down or becomes stable and is not, you know, ripping, if Bitcoin races higher, then the alts don't do very well. But when Bitcoin goes up slowly and is quite balanced, then a lot of altcoins tend to outperform. And the ones that outperform first are the big ones. So you'll see rallies in the big coins, and then you'll see, and then they'll stop, and then the money will flow into the, as risk, you know, tolerance increases, money will flow into the kind of medium-sized altcoins and then the smaller ones. So they all tend to rally one after the other. And this rally in Bitcoin, sorry, this pullback in Bitcoin has been really good. Like, you know, it's been a while since Bitcoin has had a long pullback and the altcoins have done really well. And that market is like huge now, huge. There are so many coins, like,
and there are, and there's continuing to be more. And so without taking without taking away too much of the detail of what you want to explain in your blog post, the one thing that
there's one indicator that I like to watch to see whether I should, you know, because when you have a cryptocurrency account, it's almost impossible to get a verified account. And unless you have a verified account, and that's that know your customer thing, unless you have a verified account, you can't go from cryptocurrencies to fiat currencies. So you can't swap, you can't sell Bitcoin and buy dollars and then take your dollars out unless you have a verified account, which is, you know, fingerprints, passport, the whole works, and takes a long time. And the exchanges are overwhelmed They don't have time to verify people's accounts. But you can have an unverified account, and you can fund it with cryptocurrencies like Bitcoin or Ethereum, and then you can trade on that exchange anything you want. So you can do whatever you want, as long as you don't want to transfer back into fiat money. You can do whatever you want. And so what tends to happen, because people can't do that, now they use a proxy for the US dollar called US dollar tether, which you might have heard of. So you can you can go into a coin that will give you the same value as the US dollar, but you can't take fiat money out. So there's been a lot of FUD about Tether lately. So what tends to happen is, if Bitcoin's selling off, people will move it into a different altcoin that instead, hoping to profit for some gains, And when you think about it, in the big whales in crypto, particularly in Bitcoin, mostly they were around when Bitcoin started with the Silk Road, and they're involved in the drug scene. The last thing they want to do if Bitcoin is selling off is put their money in a bank account. They're going to look for something else that might be going up instead. So what I think it's quite effective if you look for what's set to rally instead, because that's where a lot of the big money in crypto is going as well. And I use as an indicator, I use Ethereum against Bitcoin. So you can chart it. It's FBTC. And for me, if Ethereum is going up against Bitcoin, it means it's good and you're better off in altcoins. And if F is going down against Bitcoin, you're better off in Bitcoin.
So it's FBTC?
Echo Tango Hotel, Ethereum, Bitcoin, BTC. So the ticker, the chart you need to look at FBTC. Now, out of nowhere, from sort of the mid-December, FBTC has had a fabulous rally, and it's just stalled at 50% of the decline. So, go to it's loading the thing where we've just stalled anyway. Maybe if you look at, type it in again and you pick the Bittrex one, because that has more chart history.
BTC.
FBTC.
Maybe give the next
Bittrex.
There we go.
So here we are. You can see where it now actually stalled at exactly 50% of the decline. So we're at a bit of a decision point. We could feasibly, because this has been a really good indicator for Bitcoin, feasibly we could see a little bit of a rally. So that supports a bounce off the bottom of the wedge in Bitcoin, and a little pullback here, back to maybe your 200 moving average or the 38.2 before we continue higher. So
interesting. Okay,
well, I'm seeing it. Yeah, and look at your RSI as well on that one. That's right up there and ready to easily take a dip.
Although, I guess this is probably a better indicator to look for an RSI, because if you look at any RSI versus the Bitcoin or any other, cryptocurrency and against the dollar, I mean, RSIs have been completely useless in these rallies. But when you're doing a cross rate or more of an intermarket cross rate, I think it probably makes a little bit more sense. So that's great. And this is some great information that I think, for those of you that trade crypto, and by the way, we understand this is a currency webinar.
And so if there are people who are listening who want to do it, and it's very difficult to get, I would suggest that you get an unverified account and you buy yourself a small amount of Bitcoin. And there are a couple of websites like Uphold or Changelly where you can buy some, and then you send that small amount of Bitcoin to whatever exchange you can get on, and start really slowly, because it's crazy.
It is very crazy, and we are going to continue on with the currency market. But Nick, I want to thank you for being here. Steve, I got to pass it over to you for the PPI.
Absolutely. Nick, are you still here, by the way?
Yeah.
Thank
you.
Nick.
I'll turn the mic off.
I have a friend that's listening on the webinar, so he sent me a question. Just the last question for you, if you don't mind.
Yeah.
He says, Bitcoin is supposed to be used a lot because people want to send money without a bank intermediary. So he's taking your answer.
Yeah.
Yeah. Okay. So you send the money to someone. How does that person take the money out if his account is not verified?
Oh,
Because what you said, they cannot.
Okay, because there are some places. So I think CoinMama is one. Uphold is the one that I use. Doesn't have very good reviews on the web. So do your own research. Changely, spelled CHANGELLY, is another one where you can convert fiat money to Bitcoin and back and forward, and a few other ones as well, Ethereum or Litecoin or Ripple. And so you need to do a search for some. So there are places, most Bitcoin is not done on a trading platform. Most Bitcoin is exchanged over the counter. In almost any country, you can find people who will do
initial claims, by the way. Sorry, Nick. Initial claims came out 261 versus 245 expected. So sorry to interrupt. And PPI actually came in negative, minus 0.1 versus 0.2 expected. So that's obviously not good for the dollar. Yeah. I'm just seeing this. I just said the numbers, Blake. Yeah, PPI came especially weak, minus 0.1 versus positive 0.2 expected. That's quite a miss, actually. I'm not seeing though any huge reaction besides the USD yen. The euro remains near the highs. Yeah, I don't see much. So go ahead, Nick. Sorry to interrupt.
Yeah, I was just going to say that the best use of those exchanges that you hear about all the time when people are talking about it are people who are trading with the altcoins and the smaller coins and the ones you haven't heard of. But if you just want to buy and hold Bitcoin or hold it in your wallet at home, or you don't really need one of those exchanges, there are a whole bunch of other places where you can just buy Bitcoin or Ripple or Litecoin.
Okay, and we have a last question from a friend here on the webinar. Because it's a question for you. A question for Nick, if it's not too late. Can we have an opinion on trading the BTC future on the CME, and how does that affect the actual price almost a month into its introduction?
Okay, it doesn't affect the price at the moment, just because the volumes haven't really built up yet. And I think people are watching it to see the volume build up. And so at the moment, it doesn't have that much of an effect at all. And also remember that Bitcoin futures are cash settled, so they don't have to actually go out and buy any Bitcoin or buy Bitcoin for your thing. So I think at the end of the month, when the contract, because it's a futures contract, and I think it's going to work a bit like oil. When they settle them, they're going to have to. So we'll see buying and selling of Bitcoin around the settles, but at the moment the volume isn't big enough to swing it. But I can definitely see that changing in the future.
Okay, so you think it's going to play an important role, but we're not there yet, right?
We're not there yet because the volume is not big enough, but I definitely think it has the potential to do that, yes.
Okay.
And because it's so difficult for people to buy and sell Bitcoin, it's an easy way to do it. A lot of Forex brokers, are offering Bitcoin now. And I just want to warn you, be very careful with the leverage, because the current cryptos have crazy moves. So if you think the dollar Mexican's crazy, then wait till you do some crypto.
Okay, yeah, I think people don't have trouble believing that, seeing the incredible amount of volatility we might be having. For example, today Bitcoin is like 8.5% lower. It was lower than that, quite lower than that. But and when you see the recent price range, you would never. I mean, it looks like a normal move, right?
Exactly, yeah. You get accustomed to the chart. You think it's so biggie, no biggie, and then you look at it in percentage terms.
Yeah,
and you go,
exactly. And you see it in percentage terms, and you're like, what happened here? Yeah, exactly.
Yeah, Nick, because of the volatility in crypto here in the U.S., AARP, which is a retirement community, has endorsed Forex trading for seniors because it
that's so cool.
So
yeah,
it's amazing. And we're so happy for your success with the room.
That we're thank you. You know, it's gonna, not all of these cryptocurrencies are gonna succeed. I see this a bit like, do you remember, like, I'm old enough to remember the start of the internet, and you know, my first internet, like, and we thought AOL was the internet or Netscape. You know, you were one or the other. That was the whole thing. And look where those companies are now. And I think that we're a bit kind of there with blockchain, that bigger and better and faster ones are going to come along and take over. But you know, so there are some that are going to be real winners, but for most of them, they're like 2 years away from actually being anything that's usable. So it's, yeah, quite a gamble.
I think, you know, that was the most accurate sentence having been said already today. I mean, people shouldn't forget that even, you know, just by looking at the series and serious question marks about, you know, where blockchain technology and cryptocurrencies are moving, you know, in my opinion, the most sound advice is that somebody should only be putting money there if they think that's the thing that, you know, they're even willing to lose, because it is a big gamble, isn't it, Nick?
I think
it is a gamble. You know, some of them though are going to be winners, and I do think that, you know, blockchain technology is going to be life altering. But when you look at the valuation, for example, Ripple is touted as going to be a payment system that's going to replace the SWIFT system.
Wow.
The market, yeah, okay, but it's just the technology, and at the moment only a few whales, you know, own most of the supply of Ripple. The idea that the banks are all going to transfer over to that, you know, is a little bit, although the banks are all part owners in Ripple, but the market cap, thanks to the extraordinary rally in Ripple, where we went from, you know, 0.2 of a penny to, you know, $3.30 in a month. The market cap of Ripple is now like 4 trillion. Hello,
yeah,
it's never going to reach that.
That sounds legit.
Nick, I have a question on trading crypto. Do you teach people to only enter trades with limit orders? Do market orders get, you know, ridiculous bills if you do anything at the market? Are limit orders the way to go?
Oh, no. Most people actually have, and no, a lot of people do market. Like, they're not instant. So it's not like, you know, when you trade futures and you click the screen and you can click the, you know, we have, you can see a ladder and there's a DOM, and so you agree a price, but then you have to wait for your transaction to go through for a miner to do it. So, but no, in the exchanges they're filled a little bit quicker, but they're not instant.
Okay.
And a lot of
really
of the newer coins are faster. Yeah. So like Litecoin is much faster, Ripple's fast, IOTA is a fast one.
So when you throw in a market order, depending upon the volatility of the day, you know, it could be anywhere within what 2-3% wherever the market was.
Yeah, and no, nothing like that. But you can do limit orders and stop orders. You know, and they work a bit like futures. Sometimes you don't get completely filled, or you get a partial fill, or sometimes it will gap over your gap over you. So
wow.
Yeah, it's a bit like the normal market in that respect. It takes a bit longer to confirm. That's all. I would say at the moment Bitcoin is taking us, I don't know, about 10-15 minutes.
Yeah. Okay. Wow. Well, you know, stay safe out there in the wild, wild west, Nick. I'd pack, you know, I'd have 2 6 tons on my hip going in there, but you know, good hunting to you. And
thank you very much.
Thank you, Nick. Thank you. We had more questions, but we need to cover some.
Another day. I can come back another day. I'll come back tomorrow.
Yeah, you should, because we're getting more questions, but we need to look at, you know, a few FX pairs, etc.
I'll come back on the show tomorrow and we'll answer the rest of it.
So you can find at Nicola Duke on Twitter, and there you could find her trading room for crypto.
Yeah, Nick is the crypto queen. There's no question about that.
Yeah. Great to hear your voice, Nick. We always miss you.
That's true.
Now we have to listen to Steve.
Oh my God, yeah. I mean, compare the British accent, right?
Hey, all right, Steve, I'm going to be selfish.
Of a sweet female voice, you know, with
Yeah.
what you're getting from me. I mean, you know, it's a hard bargain. Yeah.
You know, we're warriors. We could handle it. What do you think
I
of
know.
Euro pound with its recent action? Has the picture changed?
The same thing. I was thinking about it yesterday, the day before yesterday, and last week.
Nothing.
Oh my God! Why would I want to be involved with it?
Okay.
That's the only thing.
How about above 89.50?
Above this trend line
Yeah.
here, because there is a channel here, or below this trend line, then we can start talking about it again.
Okay.
You know what I mean?
Okay.
As long as we remain in between these channel resistance and supports, personally for me, everything feels like, you know, noise, nothing more than noise.
You could go to 91 and clean out all the bears over the last 5-6 months, and then maybe top there for the end of B and then head down, or the end of
It
Q.
sure might be, but you know, to see how important it is not to be monitoring noise. We had, even if you go down to a 4-hour chart, it was clearly visible an inverted head and shoulders formation there. You know, we broke higher, but the price action was indicative of something that would not manifest to a new, you know, impulsive move higher, because it was extremely choppy. Then we dipped lower. Now we're reversing again higher. Who knows? I mean, we might be reversing once again tomorrow. As I said,
I just think it works. I just think it works as long as the dollar, and I think the dollar is headed to new lows. I think that this performs during that time period. That was my.
I can tell you one thing for sure. We did get a major rejection for the dollar at the retest of the broken neckline at 92.60.
Twice.
Yes, exactly. So there is no question that if somebody told me that they have a technical basis to be bullish the dollar right here, right now, you know, I would really probably fail to understand why that would be the case.
Larry Kudlow might be King Dollar. It looks like King Dollar is you know, being dethroned here until new low.
King Dollar has been dethroned since the very first second, actually, I think, trading day of 2017.
Yeah.
So it's already been 12 and a half months.
It's a surge. That's a surge.
And you know, a trend that has already lasted for more than 12 months should be respected. And as you see, the dollar keeps trading in a very clean technical manner, right? I mean, this kind of a retracement looked to be too shallow. So, you know, psychologically speaking, you always, I was watching at the 92.60 level, and I even put an update when we were first testing it 2 days ago, saying that, you know, be careful, this is a very important level. But deep down, I honestly believe that we can easily overthrow that level, because, you know, it was a very, very shallow retracement. And still, you know, we got it. Yeah, it held. And, you know, what can you say about a market that the vast majority of the resistance levels, you know, work immediately?
You know, Steve, I have something to say. I know the crypto's exciting with, you know, having 8% moves every hour or so. But, you know, as far as a trading vehicle, when you talk about something like currency and the dollar index really being a clean technical market, I would rather have 20 Dixie contracts on than one Ethereum or Bitcoin contract, because I can control my risk.
You don't need to persuade me. I'm totally in agreement with you. Totally in agreement with you.
It doesn't have 8% moves, but, you know, I want to trade a market where even when it's irrational, it's still rational.
Yeah.
Anyway.
I'm in total agreement with you.
Okay.
Crypto and whatever crypto represents and the way it's been moving definitely, you know, is miles away from what I would be liking to do as an investor, as a trader. It's completely out of boundaries of my risk profile. The huge fundamental questions for the future also don't permit, you know, any any real interpretations that you can be
And
sure that.
How ironic the name crypto, which reminds me of crypt, which means there's going to be a lot of dead bodies of traders trying to trade it. They'll go from crypto right into their accounts, right into the crypt. So anyway.
Crypto comes, it's a Greek word actually.
Right. What is it?
And it means hidden.
Okay.
So that's why crypt is also called the crypt, in the sense that when you found the tomb or whatever, you didn't know what was in it. You know what I mean?
Yeah.
That by itself says a lot. Hidden. There are a lot of hidden things under the crypto world, and personally, I'd rather be involved with something that's way less opaque, right?
Yes. And thank you for the Greek lesson. That's interesting.
Yeah.
All right.
Yeah.
So I'll let you be, and you could go ahead, and I know that you have a lot of things to say.
So a couple of things, because I see some similarities in several markets here, the Aussie, the Kiwi, gold. I do believe, and I still have the short pattern in play in the Aussie. I hope it doesn't hit its invalidation level before it actually reverses, because I do believe, and if you remember, I actually, when it was even in the money, I said that I'm seeing the possibility here of another push higher, but I do believe that this is going to be terminal. So theoretically speaking, we might have already seen that, because we did post a new high testing to the pip the 61.8 of the move lower. So in theory, that might even be it, but it wouldn't surprise me if we saw the move extend a little bit above 0.79. In my opinion, the Aussie looks more clean than the Kiwi, but the Kiwi is also currently testing a support resistance zone that for me it's important. Just a little bit higher is also the 61.8 at 72.60. So I do believe that both of them are at the very, 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 very last stages of this recovery. And at the very least, even if they don't roll over, to push even to new lows, at the very, very least, they should see a decent correction from more or less where we currently are. So these are two markets that I'm monitoring extremely closely. The same deal applies with gold. Now, the question, I wrote it yesterday in the chat room as well, is in gold, very similarly to the Aussie, we did push yesterday to new highs, but I'm uncertain if that satisfies, one last thrust higher. Likely doesn't. Perhaps this is a little triangle, and we need to see a final push towards the 1330 to 1338 area before we actually turn lower. But in this case, I'm not involved anymore in gold. My last attempt to be short, I got profits, 0.4% profits on half of the position, and the other half got knocked out at break even. But I'm really hoping for a push higher here as well, because I want to be short once again if we actually test these levels for a move down to 1300. So I'm not abandoning this. I'm actually monitoring it very closely, and I'm going to be involved with it as long as it does play ball and give us one more push to the upside. Now, silver, on the other hand, is somewhat diverging here. Of course, this can easily provide a push to new highs as well, because so far it doesn't look anything more than perhaps a pennant, a bull flag, depends, because it's still early in the price action. But we saw some divergence because gold pushed to new highs yesterday while silver didn't. So this is a divergence that troubles me a little bit, because it tells me that perhaps the move that we saw higher in gold has some chances of being terminal and not seeing a higher high from there. But we're going to see. Probably we're going to see a little bit higher prices first. That's what I'm thinking. Now, I know that after we got the Canadian news about the US pulling out of NAFTA. We got a lot of volatility in the USD CAD and the USD MXN, so we will definitely now visit both of them. The news came at an interesting technical level for the USD CAD. It was the 61.8 that we were testing. We saw quite a strong move higher. I know that Grega was a major advocate that USD CAD still owes us a higher high. Personally, because I respect Grega's opinion very much, and I know that he's more times than not in the right side of the market, but I'm too experienced to be trying to trade on other people's ideas. So I have to tell you that I don't know if we're going to get to that, but for me to even consider a bull scenario, I really need to see this 126.50 level, which is the range's bottom, which is now broken, of course, that might act as a resistance, break to the upside before I can believe that kind of a scenario. Unless or until that happens, I find no reason of why this shouldn't just be, a correction towards there and a resumption lower. Okay. So personally, yeah, this has been a strong move intraday yesterday, and this looks like a very nice rebound. But I'm far away from being convinced that this is the beginning of a rebound that will take us to new highs, perhaps towards the 61.8 here, before then rolling over. USD MXN. Okay, first of all, several days ago, this is the price action we were predicting for the USD MXN, which is more or less what happened. I was saying that, a pullback after pushing to new highs and retesting this area can then even push to fresh highs towards the 61.8 from there. So despite following this price action, I still have to tell you that we're not out of the woods. I mean, the move lower was a decently strong one. And I'm not really convinced, despite rebounding from a correct area, I mean, a technically sound area, I'm not seeing so much of a momentum here. I mean, really, this could end up being just a bear flag and another push to the downside. But as long as this 1920 level is holding, you have to respect the potential of a rebound from here. So 1920 bottom line in the USD MXN, a very, very critical level. Okay. So let's have a look at the yen as well, because obviously that also could affect from there. I have to say that, 60, 70, and this is where we found support, which in this case was also the 61.8% fib of the last move higher and the 50 DMA. So this 88.60 area is literally a triple confluence of supports. So a very, very important level. And if the market fails to hold this level, things are not going to be looking good. Okay, but definitely trying to sell it as we are sitting on triple support makes no sense, right? This pair is also very, very close to an area that will probably point to the next move of the market. I think a little bit more patience there is the way to go. Now, having to do with cable and the euro, I have to tell you, this is what we drew like a couple of days ago. What was it? I've had to answer this question probably 50 times, during the past few weeks. Yes, I remain bullish the Euro USD and bullish the cable, because the technicals and the price action tells me that every single move we've seen lately to the downside has everything you expect to see in a corrective move. Do I care that positioning is overweight being long the euro? Yes, I do. Yes, I do. Because I have in the back of my mind that at some point in the near future, we're going to see a big reversal for X reason. Perhaps the Italian elections is going to be one of them as we approach there. And then, so extreme pure positioning is like throwing fuel on the floor, right? It's completely safe as long as you don't light a match. So extreme positioning is an element, a catalyst that you need to unravel a move, but you also need a trigger. So unless or until I see that match that can reverse the pair and then make positioning important, I don't care. I still look to the upside. Okay, same with the cable.
Give us a Greek word for catalyst. Give us a Greek word for catalyst.
Sorry to tell you, it's a Greek word.
Yeah. That is a Greek catalyst.
Yeah, it is a Greek word. Catalytis.
All right. I love it.
Okay, so yeah, and even if you want to see it like that, the Euro USD broke above a major, big bull flag, and having a big bull flag here makes sense because you also had a very big and prolonged pole of the flag. And as long as we remain above this 118.50 area, there's nothing, no bearish scenario that it's even worth discussing. Okay, same with the cable. The cable is moving much more slowly to the upside. In my opinion, this whole move might end up being a corrective move to the huge move lower we've seen. But even as a corrective, slow grinding move to the upside, it has still not stopped producing higher lows. Low, 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 low. Let me mark it. Low, higher 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 low so far, right? I don't think there's anybody that can doubt that. So why would I be bearish? Okay, let's have a look at a few questions. The rand. Yeah, sure. I think somebody asked Blake yesterday about the USD. ZAR. Here it is. I've been tracking it. I've been trading it to the upside when we were here, and something stupidly I lost a move to the downside because I should have simply sold it when it broke below here. The reason I should have done that is because then that proved with absolute certainty that this is the structure that was in play here, right? Just zoom out and have a look what I'm talking about. Strong move lower, corrective move higher, which after breaking above this triangle gave us the impression that the USD rand might be actually reversing, but having been rejected from there, which is the parallel of this trend line, and then having broken below here, actually it even gapped below here in a sense. It's obviously bearish. I know that somebody's going to say that it's stalled more or less at that low. Personally, I view this consolidation once again as corrective. This was a corrective consolidation. This is likely another corrective consolidation of some kind, and I'm not even going to change my mind even if we move higher from here to come back, retest that area. Actually, I'm going to tell you in advance, if we come back and retest this area, I'm going to be selling it. No questions asked. Okay, So, and something else, we had a reading close to 20 in the RSI. These kind of readings are not readings you see in the RSI when you find a bottom. These are readings when you might be finding a short-term bottom, but show you that the direction of the trend is lower. So I'm 100% bearish the USD ZAR. My view on black gold. Sure, I'm going to give you my view on black gold. And we actually had a question about gold from Kerem. Gold question, please, please, please. This might be asked in the past, but not maybe. Would you look at price when you buy physical gold, or would you straight out buy it? Also, what kind of percentage would you put in silver and how much in gold? Listen, my friend, I cannot answer that question for you. I can tell you, I can only answer that question for myself. Do I own some physical gold? Personally, yes, I do. What kind of percentage? I would say not more than 20%. I mean, if a friend asked, I wouldn't suggest more than 20%. But I have to say that I agree with what you're indirectly saying. Yes, I would be doing that with physical gold. Do I believe that gold is going higher in the medium to long term? I absolutely believe that. So, but it's totally up to you, because it's an investment decision that I cannot make for you. You can make for yourself only.
Steve, just want to remind you we're into the interview.
Oh, I'm very sorry. Yeah, because we had Nick as well, and time flew by. Yeah, sorry, I don't want to chew through your interview. So we answer the rest of the questions obviously tomorrow, and for the ForexAnalytix members, we will be at the chat room. So go ahead and please ask there whatever you want. We're always there for you, as you know. Thank you very much, Dale. Enjoy the interview.
Thank you, Steve. Okay, Steve, I'm going to make you a panelist. And I'm waiting to hear your voice.
All right, so I'm unmuted.
You're good, Steve. How are you?
Very well. So I'm
Happy New Year to
ready
you.
to roll.
I had the pandemic flu that they had here in the U.S. At our last attempt. I'm so glad that you came back. I'm showing your screen for Patreon right here. And just a quick introduction. Steve Keen's a professor at Kingston University, and his fame and his well-known status came from his book, Debunking Economics, and Steve was aware of what was coming in 2008, the Great Recession that wasn't so great for millions of people. And he has a mission to bring about a change on the way people look at the economy. And anytime you're trying to make a change of a system that is well entrenched, it's not an easy battle. So I congratulate you on fighting the good fight, Steve. Welcome to FACE.
Thank you.
So we have a lot to delve into, and we talked about a few things you want to cover. We may as well start with the Fed's been tightening. Now they're going to be talking about rolling off their balance sheet here, and the ending of QE mainly happening here in the U.S. When do you think Draghi in Europe's going to get on board, and what Japan did that took the yen higher this week? Is that the beginning of that happening in Japan and China? Do you think that globally all central banks will be in sync coming off QE?
Oh, most of the ones that are doing it will be trying to unwind it this year, and I think are going to find themselves winding it right back up again afterwards. I've always called QE a pact with the devil, and the reason for it is that it's part of the motivation for it came out of the model of money creation, which economists get drummed into their heads by university textbooks, called the money multiplier model, and that argues that if you create excess reserves in the banking system, that will then mean the banking system can create 10 times as much money as you add excess reserves. It's total nonsense because, in fact, banks cannot lend out reserves. If you look at the accounting behind it, it violates the rules of accounting to imagine that you can lend your assets out and create more liabilities in doing that which is what is actually involved when you create a loan. You increase your assets by creating the loan as a bank. You increase your liabilities because you put that money in someone's bank account. That, of course, is then a liability of the bank. So it involves an increase in assets, not a decrease in assets. To talk about creating money by lending out reserves means somehow you're going to reduce reserves and increase lending. Now, there are some circumlocuitous ways that it vaguely can be done, but fundamentally that's a wrong model of banking. So that was one major motivation for it.
Okay, so do you believe that we're in the final stages of the fractional reserve banking system that we have?
No, I don't, for a simple reason: it doesn't exist. This is one thing which is very frustrating for me, trying to communicate these ideas, because people are often pro or against something which doesn't actually exist. It's an economic model they learnt in textbooks at school or university, but it's a fallacious model. So fractional reserve banking implies that banks lend out their reserves. They don't. And this is, I try to get people that they're trying to understand this, to draw up a basic accounting table, put assets on one side, liabilities on the other, and equity is the gap between the two. And fractional reserve banking implies that a bank has to wait for a depositor to put money in, which increases their liabilities, increases their reserves as well. And because they both go up by an equal amount, they're supposed to have excess reserves, which they then lend out. That means deducting something from your assets. If you deduct from your assets, you either deduct also from your liabilities or your equity. It's not a way of creating them at all.
Okay, so Steve, it's always been our contention here that the Fed was raising rates so they'd have a cushion if there was ever a need to be able to take them down again. You can't take them down from zero. Is that your view? Is that the tightening that's going on is just so central banks can attempt what they did in 2008 again, if need be?
No.
No? Okay.
No, I mean, again, you have to realize what you're dealing with here, and that is you're dealing with a bunch of economists who've been trained in a completely fallacious but superficially convincing theory of how capitalism functions. So what they're actually doing is they're applying their model. And the model that dominates mainstream economics these days, even after its catastrophic failure to warn of the financial crisis back in 2007-8, are called Dynamic Stochastic General Equilibrium Models, DSGE. Sounds fancy. It's a very fancy word for a very clunky way of modeling the economy. But an essential part of that clunky way of modeling the economy is they treat the financial sector as an echo of what's happening in the real economy. So they say that the financial sector simply intermediates what's needed by the real economy. And you can therefore build these so-called sophisticated models with no element in them explaining the banking sector or let alone debt or money themselves. So they completely leave this stuff out of the system. When you boil it down, they're very complicated models, but you can actually boil it down to three numbers: 2, 3, and 4. And what's hardwired into most of these models is, first of all, the belief that the rate of inflation should be 2%, the rate of real economic growth should be 3%, and the reserve rate of interest should be 4%. So what they're doing now is they think they've been through a huge crisis. They're now coming out of it. Thank God, for some reason it's ended. They didn't know why it started. They don't know why it's ended, but they think it's over. So they're heading back to those 2, 3, 4 numbers again. And that's what's really driving their behavior. Now, in the real world, of course, that model bears no resemblance to the real world. So they'll be forced to go into reverse before they get anywhere near those numbers.
Okay, so what do you think is going to be the catalyst for asset prices to fall across the board? I mean, there's so many bubbles to choose from.
Yeah.
Probably the biggest would be sovereign debt across the globe, corporate debt. The bond market is much larger than equity markets combined. Do you think that's where it starts, that it will be an unexpected rise in long-term yields that are the catalyst for people to say, well, these valuations were crazy when rates were lower and they're really crazy now, and start to liquidate assets?
No, sorry, I don't. The 2 points that I see the bubbles reversing, the reversal of QE, because that's actually driven a large part of the asset price bubble, and then also the level of private debt that's been accumulated, household plus corporate debt. That's far more important than sovereign debt. and in fact that's also far higher than people realise at the moment.
Are people households more leveraged than they were at the highs in 07?
No, they're lower. They've got a lower level of leverage, but it's still a high level of leverage than has applied in history before the Great Depression. Okay. So if you take a look at the data for America, for example, I'll bring that up. If you can actually hand over control of the screen to my computer for a tick, I'll show you something which would be useful.
I'm going to make you the presenter.
Can you do that?
Yep.
Okay, now I'm looking at, okay, so show my screen. Yep, okay. So that's the web page of my not well developed as yet Prof. Steve Keen web page, which I'm moving to from Debunking Economics. But this shows the data for the levels of private and government debt around the world from 2016. I haven't got it set up as yet with a database that updates dynamically, but I'll simply show you the data for the USA, which, pardon me, I've gone slightly past my screen here. So if you want to see this, I'll just actually highlight that's the URL there, Prof. Steve Keen / ridiculous long URL, data on credit and employment and house prices. But if you go there for each country, you'll see that I've got the data for them taken from the Bank of International Settlements. Now, the red line there is the one that everybody obsesses about. That's government debt. The blue line is the one that matters,
wow,
which is the level of private debt. And you can see that peaked at about 170% of GDP immediately after the financial crisis, fell to about 150%, is now rising once more. Now, if you look at that and say, what's that doing to demand? My metric on demand is that, pardon me again, I've jumped too far. Demand is a combination of the turnover of existing money plus credit. Now, we don't actually measure.
Is that like
velocity? Velocity of money times the money stock, okay, which we don't actually measure properly these days, plus credit.
Okay.
Now, we don't actually have an accurate measure of the velocity, but if you look at the figures that I've got there for GDP and GDP plus credit, there's some double counting involved in that because some credit is used to buy goods and services, but about 80% or more of credit is used to buy assets. So if you look at the data, that takes us from 1950 right through to 2016. And you can see with the black line, which is graphed against the right-hand axis, credit, which is the annual change in debt, was always pretty much above 5% of GDP, except for a little dip back in the 1990s, hitting 15% of GDP when the crisis began. And the crisis began because credit went from plus 15% to minus 6%. That's your cause of the crisis. Now, since then, you've now had a revival of credit-based demand, but because, just to go back up on screen, because you've got such a high level of debt already, you're sort of close to the Mount Everest level for the American economy in terms of its capacity to cope with carrying private debt. So any revival that's going to happen from here up will not take you much. It may not even take you back to this peak level of debt of 1.7 times. Maybe it might make it past to 1.8 times GDP, but it's not going to rise like it did from, back in the 1950s, from 50% to 170%. So credit-based demand will never be strong again. And that's what the Federal Reserve and co. simply aren't aware of.
As a chartist, I'm wondering, maybe you could turn your volume down because I'm hearing the background.
Yeah, I'll turn it down.
Looking at the charts that you're showing, so I think it's in the webinar that's making it echo. But all these look like are retracements, like the black line has come halfway back. Would it be more negative if we just start rolling over from here, and is that possible?
Well, it's what's actually happened in the case of Japan, and that's what I see as the canary in the coal mine. We should have taken notice of something like 30, 40 years ago. If you look at Japan, I think Japan pre-tells the history that we're all going to live because it's been through this from 1990 on. So here's Japan's data. You can see Japan's private debt level peaked at 220% of GDP. It's then been coming down. It's coming down as public debt rises because public debt compensates for the fall in private debt. And what they've been through, and this is now, look at the black line here for Japan, credit, when their crisis began, peaked at 28% of GDP. It then fell to minus 12%, which is why they had such a huge slump. But since the late 1990s, credit has either been negative or barely positive. and that's been going on for 20-something years. So we're retracing the same basic dynamic. Now they're finally back in a period of moderately sustained credit growth, but what happens is not a retracing. They tend to stay at this very high level of private debt, and you can see even though they've been, it's fallen substantially from the peak they had back in 1990. It's flatlining at about 160%, and it's been there for ages. Now, if you go back to before their bubble began, because Japan had what they actually literally called the bubble economy from 1980 to 1990, the bubble economy began with a debt level of 1.4 times GDP, rose to 2.2 times. Even with all the deflation, still the decline in debt since the peak, they're still not back to the level they had back in the 1970s. So what that means is it's like you got to, in fact, you can regard a level of private debt as being like an anchor around your ankles when you've been asked to run the 100 meters. The bigger the anchor is, the slower you're going to do the 100 meters. The less credit-based demand it is, the more sluggish your economy is going to be. Of course, we know Japan's been in that situation for 25 years. The US and UK have entered that position after the 2008 crisis.
Okay. So what's on the horizon? Do you think things begin to unwind in 18, or are they going to have the ability to keep all these balls in the air for a few more years, maybe into 2020? Is there any time element that someone like you can see whether something is becoming acute or it's just still chronic for a while?
It's time and location, Dale, because in terms of location, I would rule out the United States, the UK, any country that had a big crisis back in 2008 as a site for a future major crisis in the immediate future, because with that level of private debt they've already accumulated and the low level of credit growth after the bubble, you're not going to see huge growth in credit subsequently. And because you won't see huge growth in credit, you won't see much of a fall in credit either. So to show you the example, the data for the USA again, let's go back and take a look at it. What you can see there is credit demand was running at averaging about 8 to 10% of GDP all the way through from 1950 till the crisis. Since the crisis, it turns negative for the first time since the Great Depression. Now it's sort of topping out at about 7% of GDP. Now you can see you trace back for most of the time, except back in the 1990s recession, credit's been above that level. So what you have is fairly anemic demand from credit. So if it falls, say, from here, it's plus 6 or 7%, even down to the depths it reached of minus 6% back in 2010, it's not as big a fall as it was for 2008, 2010 itself. So I call the United States, the UK, Spain, most of Europe, the walking dead of debt. They've had their crisis, they've been turned into zombies. Zombies don't have an exciting sex life, so they're not going to be the ones we're going to see it. But if you go to other countries which managed to avoid the crisis by continuing to borrow money, say, for example, Canada, then what you can see is its debt level was 170% of GDP roughly when the crisis hit. It's now 220% of GDP, far higher than America. If you then take a look at what's happening with their credit levels, they're talking substantial levels of credit. They are going to have a downturn when they are now starting to reach peak credit. And so it's the countries that avoided the crisis by borrowing more money that are going to have it. Obviously, I see Canada as one. The same for Australia. Here's Australia. It was 1.8 times GDP. Right. Now it's 2.1. You take a look at this is all, the data's slightly out of date, by the way. I don't have an up-to-date set of charts on my website, but I do have that on my computer. I could actually bring it up if anybody asks.
You know, these are, you know, the currencies are, I call them commodity related currencies.
Yeah, that's true.
Do you think that perhaps a bull or bear market in, say, oil for Canada and iron ore and other metals from Australia will suffer during this time frame, that prices will be under pressure? Or could a bull market in commodities soften the blow for Canada?
The bull market would soften the blow for them, because that's a major reason why Australia and Canada got through the crisis so well. They both had housing bubbles which didn't burst. Australia re-inflated its bubble. But what kept them going, of course, is enormous demand from China. So if you look at the Chinese economy, again, that is now, I mean, Chinese data is rather hard to trust, But you can see China went from 1.2 times GDP, okay, to almost 2. That's the fastest rate of growth of private debt in the history of capitalism. And that's what's...
This has got to be where the black swan is going to land.
You take a look at this, is again the same comparative chart. So you can see that in 2010, credit was almost 40% of GDP in terms of its scale of demand. And but what China can do, the Western countries can't do, is very rapidly flip over to government spending. So if you look at the level of government financing during the crisis in America in 2008, the so-called Obama stimulus maxed out at about 10% of GDP. I've seen some people claiming that China's current level of net government spending is 15% of GDP. And a good friend of mine who works in very large-scale infrastructure says that's an understatement. So the scale of government spending can attenuate the downturn in private credit. So China will have a credit crunch, it has to have it, but it can be attenuated much more rapidly than it will be by countries like Australia or Canada, or actually in that case, South Korea. I'll quickly show you Korea's data here as well. Again, remember, this is about a year out of date. But Korea also borrowed its way through the bubble. It's also got high levels of credit, which are now turning down. So I expect the crunch to occur not in the US and UK and Europe, but in to go through in terms of scale, China with the attenuation of its government spending, Canada, South Korea, Australia, and then a range of unlikely countries, but rather smaller ones, Belgium, Norway, Sweden, Singapore, and so on.
Okay. So do you have any view on what's going to be a store of value in this? Is it going to be flight to quality back to the US dollar? Could it be gold? And I know everyone has to talk about it. You call them those bloody cryptos. Maybe we should make a shift there, Steve, and tell us what your view is, and would they fit into your new model that you're working on? Yeah,
well, I think, like for start, the usual story that happens whenever there's a downturn in any other country, everybody rushes back to the American dollar. Okay. So I expect to see a crunch for several major countries, not on the scale of America, of course, but Canada, South Korea, Australia, the three larger economies are going to have a slump. Also Belgium, which means you're going to have some worries with the euro, Norway, Sweden, Singapore, and of course the fund managers in those countries will pull out of the local currency and buy into the dollar. Okay,
so if really the U.S. isn't going to be, we've already had our crisis, and perhaps we're going to become zombies. What's going to force the Fed to reverse course on QE? Just the fall in the stock market, or trying to pay lower interest rates when demand is slowing in the Treasury market? Yeah, what's going to be the catalyst?
Well, let's go through what QE actually did, because there's a lot of myths about QE itself. But look in the American economy, QE was running at about $80 billion a month, which is roughly $1 trillion a year. Now, for a start, let's just let one thing nice and clear using that example. Did you see QE mentioned on your tax returns in the last few years? Of course not. Okay, the money was created.
I have a copy machine, but my counterfeiting skills are.
It's just basically the double entry bookkeeping. They say we're putting $1 trillion into the bank accounts of banks and non-bank financial institutions. They're giving us $1 trillion worth of bonds. So it's simply double entry bookkeeping that creates the money. But the whole idea was to drive banks and non-bank financial institutions out of government bonds and also out of mortgage-backed securities as well. And therefore what happens is they think about it in terms of a cash transfer. They get $1 trillion of cash from the government. The government gets $1 trillion worth of bonds from them. That means they have $1 trillion less worth of income earning assets, $1 trillion more of cash. So therefore, let's imagine they spend the whole $1 trillion on the share market, which is not going to be too far from the truth. That $1 trillion drives up the value, and let's again just say it's a straight transfer, drives up the value of shares by $1 trillion. People with shares sell them for $1 trillion profit. They then might spend, say, $900 billion of that back into the stock market again, put about $100 billion into buying goods and services in the economy, a couple of extra Lamborghinis, the odd yacht, people to clean them for you. That gives you a trivial stimulus for the scale of the money you pumped into the economy, but it does cause a boost. But the main thing it does is boost asset prices. Now, of course, if the central banks decide to unwind QE, then the whole process goes in reverse. if they tried to sell $1 trillion worth of bonds to the financial institutions, they would do the buying, but to buy it, they'd need to raise the cash. To raise the cash, they'd sell the shares. To sell the shares, the share prices will fall. As soon as that happens, the central banks will panic and go back and reverse again.
Okay, I have a question from the community. Do you have any idea, Steve, how much private consumer debt has flowed into cryptocurrencies since you can fund accounts with credit cards? And if cryptos collapse, does private debt collapse with it?
Yeah, well, this is one of the, I mean, there's no real idea of how much money people have borrowed to buy cryptocurrencies, but I've seen comments, and particularly this is actually intriguing because you would have seen in the last day or two, South Korea has banned trading in cryptocurrencies. Something that's, again, one of these things I saw on the web, so you take it with a grain of salt, but about 1/3 of Korea's industrial workers have, inverted commas, invested in Bitcoin, and a lot of them have done it by extending their mortgages. Now, of course, they're doing it. They think this is a cheap way to pay the mortgage. You know, crypto is going through the roof. There's not much inflation going on with the fiat currencies. We can make a profit that way. If cryptos crash, pardon me, if they're geared to a factor of 3 or 4, they get wiped out. So a fall in crypto can cause bankruptcies in the credit-based money and feed back into crypto again, because people will try to liquidate what they think is liquid, being cryptocurrencies, to pay their ways out of debts they have to pay back to the banks, and both could fall with each other.
Wow, Steve, what a great interview. I know that you just wanted to make a statement, and you know, I've gone to your website and I see how you have to deal with the public sometimes, and people get very emotional, and sometimes, you know, you could be emotional about economics, but you can always be civil and agree to disagree. So I know what happens sometimes. You have to block people, right? And I'd like to just ask you, the neoclassicals are going to limit the debate. Is it because they have control of the media, or is just all the strong lobbies and international corporations like the game the way it is, and that's why they're going to limit the debate, and you're going to really have to get out there on the front lines to get your ideas across? And that'll bring me to Patreon and how people could support your work.
It's more a religion. This is what I'm actually bringing up. If you can see, I'm playing with my screen right now. I want to show you some stuff from the neoclassicals, because what I'm really challenging is a religious sect. And this is not an outright criticism of economics, because in my opinion, this scientists and religious fanatics have something very in common. They actually believe they know how the world operates. The difference between the two is one tests their theories with data, and the other one just goes back and reads the good book and says this is what the Bible or what the Quran says, so it has to happen. But if you look at what's been done by mainstream economists, they have built almost a religious belief about how the economy operates. And I'm challenging it by saying, look, it's a fallacious theory. In the sense, my favorite analogy for neoclassical theory versus what I'm trying to bring about, and I'm not the only one, of course, there's a range of non-orthodox economists as well, I've just got the biggest voice amongst them, is that we're like Copernican astronomers challenging the Ptolemaic astronomers.
Right.
With us saying, look, the universe is centered on the sun, and they're saying the universe is centered on the earth. And in fact, you can make a model in both cases which fits the data. And in fact, the Ptolemaic model with the earth at the center and the sun and the moon and the planets and stars orbiting around it was more accurate than Copernicus's model when Copernicus came up with it. But of course, it was completely wrong about the structure of the universe. Now, a similar thing applies now. And what has happened is neoclassicals were completely flummoxed. Their model fitted the data perfectly because, of course, they overfitted the data to the past, completely failed to predict the future because they don't even include the major driving forces, which, in my opinion, are the private credit system. They leave that out of the models completely. So they had zero capacity to predict the future in 2008. Now they're trying to rebuild themselves and say we can get it all fixed up by using our existing model. So this is just recently, the Oxford Review of Economic Policy published a brand new set of papers, and I urge people to download them and take a look at them, by the way, which you can do for free until the middle of February from the Oxford Review of Economic Policy. And you'll see that's what they think the economy is about. Now, all you have to do is read a few of the papers to see effectively from a realist, a real world perspective, these guys are off with the fairies. But they're defending their surf because this is their religion.
Understand. They're apologists.
Oh, they don't even know they're apologists. They actually believe they know the truth.
Okay. All right. So, Steve, really an amazing conversation I'd have with you. And how can people that are hearing us live now and that will see the video later become part of your movement to,
well,
you know, make this economy fairer for everybody?
Yeah, I'm trying to make us. I'm not a revolutionary. I'm not an apologist either. My perspective on capitalism is there's no point campaigning to change it if you don't understand it in the first place. So I'm trying to build realistic models of capitalism, building on the work of a whole range of non-orthodox economists, including people as diverse as, to some extent, some parts of the Austrians, Joseph Schumpeter, Hyman Minsky, a guy called Goodman, most of you wouldn't have heard of, John Blatt, another one you wouldn't have heard of. I take some ideas from Karl Marx and I take them from Quenet and Cantillon and so on. So I'm trying to build a realistic approach to economic theory. And I've given up on universities as a place to do that because effectively the religious neoclassical mob have taken over the major universities, Oxfords, Cambridges, MITs, and so on. And characters like me only get to teach at low-ranked universities, and we just don't get to reach the good students, and we don't necessarily get the critical voice we need in the university sector. So I'm going public. I'm the first economist to be successfully crowdfunded. I'm one of two. Richard Wolff is another, through Patreon. I hope you can see my Patreon page right now.
Got it.
And that's where I put most of my posts through right now. I've got a nice community there, about 800 and coming up to 850 people. And that's enabling me to continue acting as a independent public intellectual and to challenge the basically fallacious orthodoxies of both the left and the right on economic theory.
Well, Steve, you know, I would say I'd love you to replace John Carney at the BOE, but if you had your way, there probably wouldn't be a BOE.
No, we need a central bank. Central banks are clearing houses for private banks.
All right, well then Steve King for chairman of the BOE is what I say.
I'll hold my breath on that one, mate. Actually, I won't hold my breath.
Well, you know, thank you so much for your time, Steve. I encourage people to go to Patreon and read about Steve's views and keep in touch. Steve, I'm sure you're going to be, as things begin to unfold and QE begins to take effect on the different asset classes, this is going to be a good place to see all your posts, correct? That's
correct. Yep, that all goes through here.
All right. Well, great having you back. Thank you for coming back to speak to me again, Steve. And I'm a fan. And anything I could do to promote what you're doing, I will. It's a promise.
Well, thank you, Dan. Much appreciated.
All right, Steve. Everyone, thanks Steve Keen for being with us. Go to Patreon, visit it, educate yourself about what kind of system we're living under, and if there is going to be a great reset, perhaps how it could change, and enjoy the rest of your day. Most of all, don't just count your pips, count your blessings. We'll see everyone for TGIF tomorrow. Thanks again, Steve Keen. See you, Warriors. See you, Eagles. Enjoy the rest of the day. See you in the private chat.
Okay, bye all.
Thank you, buddy.